Joining us, Bob Elliott, co-founder and CEO of Unlimited Funds. Bob, happy Friday. So wages behaved even though the jobs number was a little hot. Why do you say here neither stocks nor bonds look great?
Well, I think the main thing is on the stock side, we already have expectations that are pricing in something like 2 or 2.5% real growth through the course of 2024. In that circumstance, that's basically where we're at with growth. And the employment data largely confirms that. I think the real risk is on the bond side, where, bond yields today printing their highest close of the year. And even there, still pricing in cuts from the Fed at a time when growth is strong, unemployment is at secular lows, and those pesky inflation pressures keep picking up again, which will cause some hesitation from the Fed to transition to that cutting cycle.
So just as we're in need of more data, we got bank earnings right around the corner. What's the most important signal to get from those calls?
Well, I think you've got to look at the deposit dynamics in the banks. And certainly at a macro level, when we look at the weekly data, we're actually seeing deposits start to pick back up for the smaller banks as well as stabilize for the larger banks. That's all pretty good when it comes to the bigger financing and liquidity risk that those banks were facing. The really interesting thing that's going on there is that we're also starting to see a bit of a pickup in the loan book, particularly from some of the larger banks. That suggests that maybe there's a little bit of credit finance reacceleration in the economy going on right now. That's not what the Fed wants to see when they're looking at an economy that should be slowing to some extent in need of cuts.
So what does that mean in terms of the landing thesis, if you will? I mean, on the one hand, you've got a lot of macro resilience showing up in the economic data, including the jobs report this morning. On the other, commodities are moving higher. Crude has had a big move this week. We've seen the dollar strengthen, and to your point, I mean, you got the 10-year Treasury yield at 4.4 now, highest since November. Seems like something's got to give here. How does it speak to how this economic landing is materializing?
Well, I think what we're seeing get priced into the stock market and commodities is we're starting to see a no landing scenario pretty much priced in at this point. And the same is true increasingly on the short end as Fed cuts start to get priced out. The main place where that no landing scenario isn't priced is on the long end of the bond market, which, while it's pressing highs over the course of the last couple of months, we're well off where we were last summer when bond yields hit 5. And even then, we didn't have a meaningful slowdown in economic activity. So I really think that long end is the area of the market that is most meaningfully mispriced. And that's coming at a time when we're getting a bunch of inflation data next week, combined with almost $120 billion of bond sales. That flow, that constant issuance, financing those large deficits, that constantly is going to weigh on the bond market, particularly here in the second quarter.
Okay. Cash, should that be a part of your portfolio right now? And I ask that because Bank of America report showed that $82 billion in the week through Wednesday went into cash funds. That money market funds are now annualizing $1.2 trillion of inflows. It's the second highest ever. So clearly investors are putting at least some money to work there. Does it make sense in this environment?
Well, I think, cash is never a great asset to have unless you can truly market time. It's generally better to be invested in assets on a tactical basis with stocks where they are at this point, and the pricing in of very, very high growth expectations and bonds not looking great. Cash can be an interesting alternative, though. When you think about what assets are out there and where there may be interesting opportunities, might look to the commodity space where we're starting to get conditions aligning for a bit of a short squeeze for those people holding large short positions in oil. And then, of course, there's my favorite gold, which, keeps pushing higher.